Welcome everyone. In the last session we have started with the new module, preparation of financial statement in compliance with the INDAS standards, and we have discussed about the theoretical aspects with regard to the same area. So let us continue with the practical case. Before we go further into the practical case, you need to have an idea about how the statements are prepared as per the INDAS standards. Next area, presentation of balance sheet, otherwise known as statement of financial position, which can be abbreviated as SOFP. So familiarize the headings. Presentation of balance sheet was the usual term which we have been using until now, and statement of financial position is the name given to the same statement, but this name is specified under the INDAS standard. So you have to familiarize both the terms. SOFP means statement of financial position, and in some of your theoretical cases and in some textbook, instead of using the entire point, they will note down this abbreviation alone in the theory part. So don't get confused with the abbreviation. So we all know that balance sheet is the position statement or the statement that consists of assets and liabilities. But if we go further deep into the preparation of statement of financial position, you need to have an idea about a list of items. So before we go in deep, we have to have an idea about the presentation of balance sheet, otherwise known as SOFP. INDAS 1 uses the title the statement of financial position. This title is not mandatory. An entity may use other titles such as balance sheet as long as the meaning is clear and not misleading. So that is the concept with regard to the title. The statement of financial position is also known as balance sheet, presents the financial position of an entity at a given date. The given date will be the end of a accounting period. It comprises of three main components: assets, liabilities, equity. In the beginning of the session, I have mentioned that there are two items, assets and liabilities, but in the INDAS point of view, you need to consider the equity more important or relevant when it compared to with liabilities. We know that liability includes capital and other liabilities, and capital in wider sense, the capital is known as equity, and we have to identify equity separately. Even though it is recorded in the liability side, you have to specify it separately. So three important contents of a balance sheet or SOFP is assets, liabilities and equity. The statement of financial position, otherwise known as SOFP, helps users of financial statement to assess the financial soundness of an entity in terms of liquidity risk, financial risk, credit risk and business risk. We all know the main purpose of financial statement is it is statutory or mandatory, and other main relevance of preparation is providing necessary information to its users. So these are the various areas in which the investors require information. What is the liquidity position of the concern? Whether the organization is having sufficient cash balance or not. Financial risk, whether they are able to meet their financial obligations. Credit risk, whether they are able to repay the loans. Business risk, it is an inevitable factor in a business. So statement of financial position provide necessary information regarding these types of risk to the investors. So when reading your balance sheet, it represents what your business owns and controls, which is known as assets, what it owes, that is liabilities, and the investment that the owner has contributed, which means equity at a particular point of time. That is why we are splitting the contents of SOFP into assets, liabilities and equity. The statement of financial position is formatted like the accounting equation. I believe you all know what is meant by accounting equation. Accounting equation is assets equal to liability plus owner's equity. In the smaller classes, you might have learned that equation assets equal to liabilities plus capital. Anyway, from now on, try to give emphasis on with the term equity rather than capital. In capital and equity, even though they remain, so they are synonymously same, the depth of the meaning with regard to those terms is different. In narrow sense, it is known as capital, but in a broader or wider sense it is known as equity. So let us use the term equity rather than capital. So the equation is assets equal to liability plus owner's equity. So we will begin the statement with assets. And if you come across some of the text, other authors of different, there are many authors around the world that deals with the same field, that is accounting, and you may come across different types of format. Anyway, the SOFP consists of assets, liabilities and equity. There are no other items. Even if the author is from any part of the world, the contents remains the same, but the pattern of presentation may be different. From here we are going to learn the pattern where the statement is prepared, or the statement of financial position is prepared vertically. Previously in the balance sheet we were using the horizontal format where liabilities is shown in the left side and assets is shown on the right side. But in the statement of financial position we will be using a vertical format where we will begin with assets. After writing down all the details of an asset, we will write down the details of the liabilities. So we will be using a vertical pattern, and in vertical pattern we will be using the format where we will start with assets, after that liabilities. But sometimes you may come across other texts where the authors has used another pattern in which they will begin with liabilities followed by asset. So don't get confused. Anyway, the statement of financial position consists of main three items: assets, liabilities and equity. Next one, format of a balance sheet, otherwise known as statement of financial position. For the time being, I will show a rough format of the balance sheet. See, this is actually the format of a balance sheet as per the INDAS 1. See, the form of balance sheet as per the revised schedule of 6 as per INDAS 1, and it will be written like name of the company, balance sheet as on the closing date. In this case they have started with liabilities item, see, equity and liability, but we will be learning the pattern where we will begin with assets, and in the examination also try to follow the pattern which we are going to learn. You can either begin with liabilities and after that you can go for assets, or you can go with the assets first and after that liabilities. It's up to your discretion, but it is better to follow the assets first. Anyway, the pattern is like this. This is known as a vertical format where contents of the statement will be written downwards. First of all, we will begin with equity and liabilities, and the term equity will be shown separately. Equity means shareholders fund. Shareholders funds include capital, reserves and anything that is owned to the owners. Anyway, we will discuss in detail each of these items. Once you write down the details of equity and liabilities, take the total of it. After that you will go for the assets, take the total. So this is how the format of a statement of financial position looks like, and now we will discuss in detail each of these items. So for the detailed discussion, I will be splitting the statement into two halves. That is, in one slide I will be discussing in detail the assets, and in the another slide I will be discussing the details of the liabilities. So don't get confused. You need to write down the assets and liabilities in two separate pages in an exam. Don't get like that. The statement has to be prepared in a single paper. If not, you can go on continue to the next page, but the statement is not two separate sides or not two separate items. That is, assets is one part and assets liabilities another part. Doesn't think like that. Please don't think like that. It's actually a single statement beginning with assets. After that we will continue with the liabilities. For the convenience of the discussion, I will be splitting assets in the one slide and the liabilities in the other slide. Remember, the pattern is a single statement. So anyway, let us go back to our statement. Format of balance sheet or statement of financial position. See, this is the format. We will begin with particulars. It doesn't mandatory that you need to have another column showing the serial number. You can begin with particulars. After that, note. If it is not a mandatory part, this is writing down the note. I will discuss about the purpose of showing the note column during the practical cases. Anyway, particulars, note number. It's better to write down note number. I will mention why we need note number. Particulars, After that, a small column, note number. After that, figures as at the end of the current reporting period. Simple meaning means current year value of that item. If it is an asset, then show the current year value of the asset. Another column, figures as at the end of the previous year. That means value of asset or liability that is shown in the previous year. So this is the current year balance and this is a previous year balance. And in almost all the cases in the question you will be given only the details of the current period. You need not have to worry about anything regarding the figures of the previous period. If you come across a question like that, don't worry, write down the item. If there is a details regarding first one, property, plant and equipment, in the question they have given the details of current period as well as previous period. Write the amounts in the respective columns. Don't worry about it. Usually you will come across a question where current period details is only given. Anyway, this is the pattern, particulars, note number, current year value, previous year value. We will begin with assets. In the assets column, first item is non-current assets. We have learned that the assets can be classified into two, fixed assets and current assets. But as per the INDAS, we instead of using the fixed assets, we will be using non-current assets. So first one, before we go further in detail with regard to each of these items, you need to have an idea about some important terms. I believe you all know what is meant by non-current asset. Right now I have mentioned. And I believe that you also know the term meaning of current assets. Any assets having a value or life within a period of 1 year is known as current assets. Anything has a value or life more than 1 year is known as non-current assets. These are the basic aspects you have learned in your smaller classes. Another important term you have to keep in mind is operating cycle. In the questions and in the examination, you will come across the term operating cycle. An operating cycle is the time between the acquisition of assets for processing and their realization in cash or cash equivalents. Usually, the normal operating cycle is assumed to be 12 months. So, the simple meaning of operating cycle is financial year. We all know accounting year or financial year comprises of 12 months or 1 year, and operating cycle is otherwise known as accounting year or financial year. And I have mentioned an explanation with regard to asset, that is any asset that is in use or operation for more than 12 months or more than operation cycle, it is comes under non-current asset. That is the meaning. Next one, assets. First one, non-current assets. I believe you all know what is meant by non-current assets. After that, property, plant and equipment. Remember, study this format correctly. You have to write the same pattern in the examination. Don't use your own terms. First one, property, plant and equipment. The property, plant and equipment consist of land, buildings, plant and equipments, bearer plants. Bearer plants means property, plant and equipment like that. Aircraft, vehicles, furniture and fixtures, office equipments, assets under lease. You might have obtained an asset from another party for lease, and that comes under the property, plant and equipment. So in simple terms, property, plant and equipment consist of fixed assets. That for your convenience purpose only I am mentioning that. In the format it is known as non-current assets. Under non-current assets, plant, property and equipment, property, plant and equipment. So contents of the property, plant and equipment. So familiarize these items. You have to write this item in the same pattern prescribed here. If there is any other adjustments with regard to any of these items, that is during the year certain land, additional land was purchased or additional building was purchased, one more vehicle was purchased. If there is any additions in these items, you need to add those addition and show the net value. And if there is any depreciation associated with any of these items, you need to consider the depreciation also. So in general, you need to show all the adjustments on these assets and show the net value. Next one. Next item, capital work in progress. It represents the expenditure incurred on constructing or acquiring fixed assets which are not yet ready for use. For example, advances given to the supplier of fixed asset are not shown under this heading. So remember that. Actually, the capital work in progress means the company might have spent a huge amount of money for the installation of a machinery. So it cannot be installed overnight. It will take time to bring that fixed asset in order to use in its full potential. So that is known as capital work in progress. That is, something is going on in order to make that item complete for the full utilization. That is known as work in progress, and capital work in progress relates to assets. And remember, any amount paid to the supplier for as an advance or any commission with regard to the capital work in progress, we cannot add in this heading. Next one. Investment property. Next one. Here there you can see that certain lines are given and it is mentioned with various tags. Kindly don't mind these tags because it is actually a format that is taken directly from the Ministry of Corporate Affairs. So they are mentioning each item because they keeps on updating the statement. So they are showing that this item is renamed. Earlier it was given another name, now it is renamed. So don't worry anything about these arrows and the tag relating to each of the items. Just consider these points only. So first one, non-current assets under the property, plant and equipment, capital work in progress. After that, investment property. According to IND AS 40, investment property means land or building or both which is held to earn rent or capital appreciation or both. In simple sense, if you are owning a business or a building, you are providing it for rent to someone else, and income generated from such sources is known as investment property. And reconciliation of the gross and net carrying amount of each class of property at the beginning and end of the reporting period shows additions, disposals, acquisitions through business combinations and other adjustments, and the related depreciation and impairment losses shall be disclosed separately. If there is any additions you have made on those building, or if there is any disposal, or if there is any deduction with regard to that particular item, you need to consider all those items and show the net amount. Next one, goodwill. We all know what is meant by goodwill. It is the hardest form of fixed asset. It means the financial reputation of the company and is to be required to be disclosed on the face of the balance sheet separate from the intangible assets. Just like the items which we have discussed previously, if there is any increase in the goodwill, add that amount with the goodwill amount. If there is any decrease in the value, show the net value. So that is with regard to goodwill. And as per the INDAS, even though goodwill and intangible assets, goodwill comes under intangible assets, goodwill has to be shown separately, apart from the other intangible assets. That is why goodwill is shown first, after that other intangible assets. I believe you all know what is meant by intangible assets. Other intangible assets includes brand and trademarks, computer software, mastheads and publishing titles, mining rights, copyright and patents. IPR means intellectual property rights, services and operating rights, recipes, formula, models, designs, prototypes, licenses and franchise. These are some of the examples of intangible assets. Try to find out more intangible assets that comes under the same category and familiarize each of these items, because in the question you may not come across all these items. Any one of the item may come given in the question, but you need to have an idea about what are the some examples of intangible assets. Then only you can identify that particular item and show it in the respective heads. So other intangible assets includes all these items. And just like the point we have discussed earlier, if there is any increase in the intangible asset, any of these items during the year, you need to show or you need to add with the base amount. That is known as additions. If there is an increase in an item during the year, it is known as addition. If there is any decrease in an item during the year, it is known as deduction. So in case of any form of additions or deductions, you have to consider in case of intangible assets. In case of intangible assets, especially remember, in the case of assets, fixed assets and intangible assets, there is one thing: any decrease in the value of the fixed asset, we all know it will be sale or depreciation. But in the case of intangible asset, we cannot use the term depreciation, because depreciation is title given to the reduction in the value of fixed asset that has a physical existence. Intangible asset, even though it is a fixed asset, it doesn't have any physical existence. So any reduction in the value of intangible assets is known as amortization. During the practical case, we will discuss each of these adjustments. Anyway, you have to familiarize about what are the additions and deductions like that. So in the case of intangible assets, it is the not, we cannot use the term deduction. It is better to use the term amortization. We will come to that part. Next one. Biological assets and other bearer plants. INDAS 41 defines biological asset as a living animal or a plant. There are many businessmen that are running poultry farms or cattle farms or any sort of mangrove farms or coconut farms in a large scale or a medium scale, whatever it is. Anyway, there are many businessmen that are engaged in each of these fields. Reconciliation of the carrying amount of each class of assets at the beginning and at the end of the period, after considering additions during the year. If there is any deduction, you have to consider deductions, disposals, like that. So that is with regard to biological asset. We will discuss in detail about the biological assets. Bearer plants also comes under the category of biological assets. Bearer plant, in order to consider an asset as a bearer plant, there are certain conditions. That is, there must be a production and supply of an agricultural produce, and it should be utilized for more than 12 months. And it's not only utilization for self-use, it should be for the sale of agricultural products. So only after considering these conditions only we can consider any business or any sort of business as a bearer plants. For example, mangrove plant, mangrove agriculture field, or rubber field, rubber tree. There are many businessmen who undergo a cultivation of rubber tree, and mangrove trees, coconut trees, timber business, like that. So such kinds of businesses comes under the category of bearer plants. So let us go to another area. Financial assets. And there is one more item, intangible assets under development. We will discuss about intangible assets under development during the practical case. Right now let us go to the another area, financial assets. Financial asset refers to cash and other financial instruments such as equity and debt instruments. And again, the financial assets will be classified into these four categories. So remember that under financial assets there are four different categories. So you need not have to worry about anything regarding financial asset, but remember the contents of investment, trade receivables, loans and others. So first one, under investment there are non-current investments, because we are dealing the assets under non-current head. That is why we are using the term non-current investments. Under non-current investments, Because if I own a company, I might invest my money in other companies or in other businesses. So first one, equity instrument. If I am investing in the equity capital of other companies, that is known as equity instrument. Similarly, preference shares, investment in government or trust securities, debentures and bonds, investment in mutual funds, investment in partnership firms, and other investment. So under non-current investment, these are the various areas, but you may think that all these comes under liabilities. Remember, if I own a business, if I own a company, I might invest my money in other businesses. That is, invest my money in the equity shares of other company or preference shares of other company. I might even spend my money on government securities or on debentures, bonds, mutual funds, etc. So in the question it will be specifically mentioned that you have invested certain money in the equity of another concern. So such items should be shown in the non-current investments under financial assets. Don't consider it if you see preference shares is a liability, so we can show it in the liability. Read the question very wisely. What is this preference shares relating to? Whether it is relating to our preference shares or the amount invested by us in the preference shares of other company. So make sure that identify it cautiously. So these are with regard to non-current investments. Next one, trade receivables. Since it comes under non-current assets, we can use the term non-current trade receivables. Non-current trade receivables actually means trade receivables expected to be realized after 12 months or after an operating cycle from the date of balance sheet are termed as non-current trade receivables. Usually trade receivables, any amount that has to be received with regard to the trade conducted by us with another parties or buyers. And if you are getting the money or completing our dealings after the 12 months or after we are considering it for more than 12 months period, it is known as non-current trade receivables. Under non-current trade receivables, or we can simply say long-term trade receivables, there are again three categories. First one, we might undergo trade receivables with outside parties, or we can simply say debtors, or anyone who owes money to our concern. We may undergo secured types of dealings, unsecured types of dealing, and doubtful types of dealing. In the question, it will be specifically mentioned, identify and shown under the respective heads. Allowances in bad debts shall be disclosed under relevant heads separately. There might be bad debts in the case of a money lent to the outside parties, because all the debtors are good, not good debtors. Some may be bad. So allowances in bad debts should be made appropriately. Debts due by directors or other officers of the company, any of them, either severally or jointly with any other person, or debts due by firm or private companies respectively, in which any director is a partner or a director or a member, should be separately stated. Any sort of non-current trade receivables with the directors, other officers of the company should also be considered. So these are the items that comes under non-current trade receivables. After that, next one, loans. We can say non-current loans. Again, under non-current loans, it consists of first one, security deposits. Sometimes we may provide loans to other parties in the form of security deposit. That is, you might have deposited our money in other business for a certain period, agreed period of time, that is known as security deposit. You might provide loans and advances to the related parties or any outside parties, and sometimes you may provide loans, other types of loans and advances. So these are the three heads that comes under the non-current loans. And again, under these three items also, we will provide to the outside in the form of secured, unsecured and doubtful. Because we might provide security deposit. Under security deposits, we will provide secured, unsecured and doubtful. So remember, under non-current loans there are three classifications: security deposit, loans and advances, other loans and advances, and these are again classified into secured, unsecured and doubtful. And after that, any sorts of allowances or debts, bad debts, and any debts due to the directors, such items will also comes under the non-current loans. You have to do it accordingly. But don't worry, during the practical case we will discuss each of these adjustments separately. So next one, after loans, the other one is others. In the question, in the university questions, they may specify about the investment, trade receivables and loans, and apart from that, if there is anything other than non-financial or non-current financial asset, it will be specifically mentioned and it should be shown under the heads others. And others includes it refers to non-current financial assets other than investments, trade receivables and loans. For example, amount receivable under foreign exchange forward contracts or receivables on account of sale of fixed assets, bank deposits with more than 12 months maturity, etc. Such cases has to be shown under the head others under non-current financial assets. Next one, deferred tax assets. In the bracket it is shown net. So what is with regard to deferred tax? This arises due to the difference between the taxable income and the reported income. When a company pays higher tax during a period than what is due, it will be reversed in the next accounting period by lowering the tax liability. It is then considered as deferred tax asset. So the simple meaning means the company might pay the tax for the period, and by the end of the period, that is during after the end of the tax payment period, the government will identify the actual amount tax that has to be paid by the company. For example, I own a company, I already paid rupees 100 as tax. But after everything computations, the government found that I have to pay only rupees 60 because I had paid an excess of 40. Actually I paid 100, but my tax is only 60. So I paid more than 40 rupees as excess. So how is it adjusted? Because the payment is already made. So it is adjusted in the next accounting period by showing the excess amount as deferred tax asset. Since it is an amount paid in advance, from our side it will be shown in the asset side as deferred tax assets. That is a difference amount between the taxable income and the reported income. In simple terms, it is a tax paid and difference between the tax paid and the actual tax that has to be paid. So that is with regard to deferred tax asset. And finally, the other non-current assets. It refers to any assets which is non-current and non-financial in nature and which has not been included in any of the headings which we have discussed now. So what are the non-current assets that didn't come under any of these heads? First one, capital advances. Usually capital advance means any advance given on the purchase of a land. That is known as capital advance. Next one, advances other than capital advances, which includes security deposits, advance to related parties, other advances. In the question, it will be mentioned specifically each of these items. The only thing is familiarize these heads, identify it where it has to be recorded, show in the correct place. So these are with regard to assets, especially non-current assets. Next one, current assets. I believe you all know what is meant by current assets. The assets of value within a period that has to be disposed or its position or its existence changed within a period of 12 months. That is, cash is turned into stock or stock is turned into debtors. So the existence of an asset change within a period of 12 months is known as current assets, or anything of value within a period of 12 months is known as current assets. And under current assets, first one is inventories. I believe you all know what is meant by inventory. Inventory is a term given to a certain set of items. So the inventory includes raw materials, work in progress, finished goods, stock in trade, stores and spares, loose tools, and others. These are the basic assets which you have learned in your classes, so we are not going to discuss in detail any of these. Next one, goods in transit. Mode of valuation shall be stated. That is how these items are identified or calculated. That has to be stated while preparing the statement. So these are with regard to inventories. Next one, financial asset. Just like the financial assets in the case of non-current assets, here also there will be another same head, financial assets. It is known as current financial assets. Under current financial assets, again there is certain headings: investments, trade receivables, cash and cash equivalents, current loans, other current financial assets. So here in some text you may see that after cash and cash equivalents there will be current loans. Instead we can use simply the term loans. And bank balances, sometimes in the text they may not show bank balance because cash and cash equivalents includes bank, but it is better to show separately the cash balance and the bank balance, and other financial assets. So these are the items that comes under the financial assets. We will discuss in detail each of these. So these are with regard to the inventories. Next one, financial assets. Under financial assets, all these items are current items. First one, investments. Under investment, or otherwise known as current investments, there is no other peculiar items that has to be considered. The only thing is that all the items under the current investments and items under the non-current investment and all the items under the non-current trade receivables, all these items will also come under the investments and trade receivables. So how these items again comes under the trade investments and trade in receivables, that specifically comes under the current assets category. The thing is, all these items that comes relating to a non-current category or non-current fixed asset, that is, the period of these investments will be more than 12 months. But when these items that comes under non-current investments and under the current investments and current trade receivables, when these items comes under current investments and current trade receivables, the only difference is that all these investments will be done for a period less than 12 months or less than a year. So that is why these items again comes under these categories. So I am not writing the items again. The thing is, equity instruments, preference shares, government interest securities, debentures, mutual fund, partnership firms, all these comes under investments also, but it is known as current investment. The period of this investment will be less than 12 months. So when it comes to trade receivables, again it consists of these categories: secured types of trade receivables, unsecured trade receivable, doubtful trade receivables, allowance that has to be considered, any debt due by directors. All these categories comes under the trade receivables also. The thing is, their period will be less than 1 year. And while recording these items that comes under investment and trade receivable, try to identify that if there is more than one investment ventures, it has to be shown separately. If there is investments made in holding company or subsidiary company or in joint ventures, whatever it is, any investment made in any particular concern, it should be shown separately and specifically. Next one, in case of trade receivables also, same category has to be shown. And after that, cash and cash equivalents. The cash and cash equivalents can be again classified into balances with the bank, check, draft on hand, cash on hand. Earmarked balances with the bank, for example, for any unpaid dividend, it should be shown separately. Balance with bank as collateral security. Sometimes the balance is with the bank to the extent held as a margin money or a security against the borrowing. The borrowings or guarantees, other commitments shall be disclosed separately. So all these categories or these items comes under the category cash and cash equivalents. After the cash and cash equivalents heading, there is another item, bank balances other than 3 above. In the cash and cash equivalents, we have included the bank balance. That is why in some texts, especially in your text, you will not find this item bank balance, because cash and cash equivalents include bank balance. So what is the purpose of this bank balance? In the number 4, bank balance. That means in the question they may specify the bank balance amount. Apart from that, there will be another type of bank balance that will be specifically mentioning about the purpose. So such kinds of balances should be shown under the head bank balances other than above category. And finally, loans. Loans actually includes, we have learned about the loan category in non-current case, that is under financial asset, that is non-current financial asset. We have learned about loans. There it includes security deposit, loans and advances, and other loans and advances. The same items will also comes under loans, but remember the period of these loans will be for less than 1 year. So such items has to be considered, and the pattern for adjusting all these will be similar in case of non-current assets as well as current assets heading also. So only the thing is, if there is a time gap between, that is if the period of those investment is less than 12 months, it should be shown under current assets category, and if it is a period issued, or if it is invested for a period more than 12 months, it should be shown under non-current assets. That is the only differences. And after that, other current assets, under other current assets, it also include the same category of other non-current assets, that is capital advances. The thing is, all those advances other than capital advances will be shown under the head others. And advances other than capital advances, such as security deposits, advance to related parties, and other advances, and the period of those advances will be less than 12 months, it should be shown under the head others, under financial assets in the current assets category. And finally, current tax asset. Current tax asset means companies pay advance tax every year on the basis of the estimated income for the year. When the tax paid for the current year exceeds the amount of tax due for the year, the excess tax is considered as an asset shown under the head current tax asset. So you may come across another doubt that we have already discussed about the tax aspect in the non-current asset. Why there is another item in the current tax? This is actually relating to the current period, and here deferred tax asset means once the tax has been paid, the excess tax has to be considered or adjusted in the next accounting period. That is known as deferred tax asset. So here in the statement, deferred tax asset may be an amount that has been paid in advance or in excess. It's better to use the term excess rather than advance. So any amount that is paid excess in the previous year has to be adjusted in the next financial year. That is known as deferred tax asset. Current tax asset means the tax paid in advance for the current period. So that excess amount has to be shown here in the current asset heading, that is current tax assets. So when tax paid for the current year exceeds the amount of tax due for the year, the excess tax paid is considered as an asset shown under the head current tax asset. So I believe you have understand the concepts. So once you write down all the items that is given in the question as per the format, take the total of both the heads, that is items of the non-current assets and current assets, and show as total assets in the concerned amount column. Once you dealt with the asset side, next you have to go for the liability side. See, this is how the liability side of a financial statement or the statement of financial position as per the INDAs. We have completed the asset side. This is the liability side. Just like I have mentioned earlier, these arrows and tags. Don't consider about these arrows and tags. Actually, these are the details given for each of these items. That is further changes that has been made. I have mentioned that. So we need not have to worry about the arrows and items, tags, name tags given here. Consider the items in the particulars only. Actually, the statement is a single statement. We have already write down the particulars before the assets, so you need not have to write down again the particulars and other headings separately, because it is a continuous statement. Once you write down the total of asset, you can directly go for equity and liabilities. It will also the same pattern: particulars, note number, figures at the end of the current period or figures at the end of the previous period. So if first of all, it begins with equity and liability. Equity, under equity it includes equity share capital and other equity. Equity refers to the claims of the shareholders over the assets of the company. It represents the value of total assets of the company minus its total assets. If you remember the equation, accounting equation, you can see that assets equal to liability plus equity. So if you want to find the value of equity, assets minus liabilities. So that is the concept of equity. And with regard to equity, it includes different categories, that is authorized capital, so issued capital, subscribed capital, called up capital, paid up capital. So there is a certain pattern for writing down the equity share capital item. We will discuss about that in detail while dealing with the practical case. Anyway, remember equity share capital, under the equity share capital there are different categories, and in these also if there is any adjustments that has to be considered. Usually any interest on capital or any gains on capital, and sometimes the drawings will be there, it has to be adjusted with the capital, interest on drawings, interest on capital, and sometimes there will be calls in arrears. So such kinds of adjustments that has to be adjusted in the equity share capital. So if there is such items given in the question, you have to adjust it with the equity share capital. We will study in detail what all items has to be added with the capital amount and what all items that has to be deducted from the capital amount during the practical case. Anyway, there is a lot of items that has to be considered under the equity share capital. We will discuss during the practical situation. After that, you need to write down other equity. Other equity simply means equity includes shareholders funds. Shareholders funds include share capital and other incomes in the form of reserves, surplus, profits, like that. So other equity usually consists of reserves and surplus, and you can't simply write the amount of reserves and surplus directly in the financial statement, because usually there will be adjustments with regard to that. So for finding out the amount that has to be shown under the category other equity, there is a certain pattern, and for writing down the pattern you should familiarize that under other equity the main contents are reserves and surplus. I believe you all know what is meant by reserves and surplus. Reserves means the amount set aside out of profit to meet contingencies, and surplus means anything more than expenses, so the income earned more than expenses is known as surplus. So other equity mainly consists of reserves and surplus. In the question, reserves and surplus may be directly given, but apart from that usually you may come across adjustments with regard to that, because there are certain items that has to be added along with reserves and surplus, and there are certain items that has to be deducted from reserves and surplus in order to find the total amount of other equity. So first of all, let us find out what are the items that comes under the reserves and what are the items that comes under the surpluses that has to be added as well as deducted. So under other equity, usually the reserves and surplus can be classified into capital reserve, capital redemption reserve, security premium reserve, debenture redemption reserve, revaluation reserves, share options outstanding reserves, other reserves, usually it will be specified in the question. If there is any special reserves, in that case it will be specifically mentioned. These all comes under reserves category. Under surplus there is only one category itself, surplus itself, and in that surplus sometimes you may have to adjust the profit and loss balance. If the profit and loss balance given in the question is a credit balance, or we can say positive balance, you can add it with surplus. But in the question, if it is given profit and loss debit balance, or it means a negative item, so it has to be deducted from surplus. That is the pattern. So anyway, let us find out how these amount of other equity can be computed after considering the items of reserves and surplus. The format is like that. We will begin with reserves. There is no rule regarding you have to begin first with reserve. You can either begin with surplus or reserve. It's up to your discretion. Under reserves, first one is security premium. Transfer to reserves, and if there is funds. See, here we have learned many types of reserves. So if there is any reserves given in the question, definitely you have to show those reserves under the other equity category. Apart from that, in the question they may specify a security premium. You have to show under reserves. If there is any amount transferred to reserves, sometimes we may transfer a certain amount of profit to the reserves. So when there is such kind of transfer occur, the reserves balance will increase. So when there is transfer, you have to add it. If there is any extra funds with regard to reserves, you have to show here. It will specifically mention any funds with regard to reserves has been created or added to the reserves. So it should be added. So these items has to be added apart from these reserves. So any reserves given in the question, consider under the reserves category. Don't worry about it. After reserves, next type is surplus. Under surplus, the first one you need to consider is opening profit and loss balance. It will be given directly in the question. You have to add it. After that, current year profit after reserves. Current year profit after reserve means during the year a certain amount of profit may be transferred to the reserve. So in that case, the reserve balance will increase. That is why we have added transfer to reserve. Here, how this amount is transferred to reserve, we have set aside a certain part of profit. So there is a reduction in the profit. So while computing surplus and while writing the current profit, you need to consider the current profit after the amount transferred to the reserve. I believe you have understand the concept. Don't worry, we will discuss in detail these cases or in practical case. Anyway, right now understand it. So current year profit after reserves, because we have already added the reserve part under the head reserves heading. So current profit after reserves from all these items, from these and from all these items less any dividend paid during the year. It has to be deducted because it is made out of profit, so it has to be deducted. Any corporate dividend tax, it's a very important item in the financial statement as per the INDAS. Corporate dividend tax, computation of corporate dividend tax is another type of question we need to learn in detail. We will come to that part during the case discussion. Anyway, corporate dividend tax and any reserves transferred. Transferred means any reserves transferred to any other purposes apart from reserves. Any amount transferred from reserves to meet any other contingencies, that is known as reserves transfer. Don't consider this transfer to reserve and reserves transferred a same item. Transfer to reserve means we have transferred an amount from profit to the reserve balance. Reserves transferred means amount from reserve is used for meeting some unforeseen contingency. That is the main purpose of using reserves, to meet contingencies. So this is a format for writing down the amount of other equity. Go through it. We will discuss this case during the practical session. Anyway, you have to familiarize this statement. Next one, non-current liabilities. Under non-current liabilities also there is another one, financial liabilities, otherwise known as non-financial or non-current financial liabilities. Under non-current financial liabilities there are some subheadings: borrowings, trade payables, other financial liabilities, provisions, deferred tax liabilities and other non-current liabilities. First one, borrowings. Under borrowings, the main items are bonds or debentures, term loans. Term loans may be obtained from financial institutions or any other parties or outsiders. So whenever term loans is specified in the question, show under this category. Deferred payment liabilities, deposits, loans and advances from related parties, long-term maturities of financial lease obligations, other loans and advances. So in the question, if you come across any of these items, you have to show under the heading borrowings. Next one, trade payables, otherwise known as non-current trade payables. That is trade payables whose period of payment or a period of liability is more than 12 months. It has to be shown under the heading trade payables, and don't worry about the item that comes on the trade payable, it will be specifically mentioned in the question. So write down the amount of trade payables. If there is any item specifically mentioning regarding comes under the trade payables, show the name under the heading trade payables. After that, other financial liabilities. Or we can say other non-current liability, that is liability of non-current not included under other headings, comes under this heading. So we will discuss that area while dealing the practical case. Next one, provisions. I believe you all know what is meant by provisions. It is almost like a reserve. Anyway, the purpose of provision is we are setting aside a certain amount of profit to meet a specific purpose. That is the meaning of provisions. So under provisions, there are no other means there are not a bunch of list of items. There are only mainly two items. One is provision for employees' benefit. It will be mentioned directly in the question, and others. Others means any other provision created for meeting any other purposes. It will be specifically mentioned in the question. So don't worry anything about it. Whenever there is a provision regarding this one, show under this heading. So that is with regard to provisions. Next one, deferred tax liabilities. We have discussed about the deferred tax asset. That is the opposite of deferred tax asset is known as deferred tax liabilities. When a company pays lower tax during a period than what is due, it will be reversed and added to the tax liability of the next accounting period. It is then considered as deferred tax liability. And finally, other non-current assets in the current liability. That means you may come across a question where all the types of non-current items will be given. If you can't find a heading for a particular item specified in the question, you can directly show that item under other non-current liabilities. That is the purpose of other non-current liability, to include those non-current liabilities item which cannot be shown under any of the above heads. So that is with regard to non-current liabilities under the liability side. Next one, current liabilities. I believe you all know what are current liabilities. See, here are some of the examples of other non-current liabilities. Just familiarize this. Okay, current liabilities means any liability or any outstanding amount that has to be paid. The company has to pay, or company is owed to pay an liability for that it has having a period of less than 12 months. Credit period of less than 12 months is considered as a current liabilities. And under current liabilities, again the first one is financial liabilities. Under financial liability, there is borrowings, trade payables, other financial liability, just like the items that comes under the non-current liabilities also. So under borrowings, first item, under borrowings, it includes loans repayable on demand. Usually loans on demand will be provided for a period of less than 12 months. That is why it is mentioned. If any loan obtained from banks, any from outside parties, loans and advances from related parties, deposits, other loans and advances. So it will be mentioned in the question whether it comes under the current liabilities category or non-current liability category. It will be mentioned in the question. You can easily identify whether it is a current or a non-current item. Anyway, show this item under the respective heads. Current, after that, trade payables. The trade payables also, those items that having or that are expected to be dealt within a period of 12 months comes under the trade payables. Usually the trade payables include these items: current maturities of long-term debt. Usually that mainly comes under the next one, other financial liabilities. Current maturities of long-term debt, current maturities of financial lease, interest accrued, unpaid dividend, any refund on application money and interest accrued on them, unpaid matured deposits and interest accrued on them, unpaid matured debentures and interest accrued on them, and other payables. I am not going to discuss in detail each of these individual items. While dealing with the practical case, we will come across these items definitely for sure. So those items has to be shown under this head. And finally, other current liabilities. The main other current liabilities are expenses outstanding. That is a common item. Revenue received in advance, any payroll taxes, and if anything that is specified in the question as a other current liabilities has to be shown under this head. And finally, there is provisions in the current also. The provisions include provision for employee benefit and others. The same items is also in the case of provisions. We have learned previously. So check the time period of these items comes under the provision. And finally, current tax liabilities, that is company paid advance tax every year on the basis of the estimated income for the year. Sometimes the tax paid by the current year may be less than the amount of tax due for the year. In such cases, the additional tax payable is a liability and is shown under the heading current tax liability. So these are the main items that comes under the statement of financial position. I believe you have got a glimpse into each items of assets and liabilities. So go through all these cases. First of all, familiarize the pattern or format for presenting the statement of financial position. After that, you need to familiarize each of the contents and what are the items that comes under each of the heading. That is very important and it is very relevant because the question is very easy. The thing is you need to identify each items and it has to be posted in the required places. So if you familiarize the format and the contents, it will be very easy to deal with an essay question. So this is the format of the statement of financial position. We will discuss about the cases that comes under the same category in the coming sessions. If you have any queries regarding any of these items, please do let me know.